We're halfway through October already. Can you believe it? We started out this month with 90-degree temperatures and then bam! Just like that, there's suddenly a fall chill in the air. So we're feeling a bit of that chill in the Twin Cities real estate market as well. Looking at market activity for September, I see some of the typical slowdown that we expect to see after Labor Day. But this year, it's really hard to kind of parse out what's a seasonal effect and what's the continuation of the impact of those high interest rates on home buyers and home sellers. And that's what I'm going to be talking about today in my market report. So if you haven't met me yet, my name is Jay Troutlowen. I'm a realtor in Minneapolis, and this is my YouTube channel devoted to all things real estate in the Twin Cities. Now, before I dive into the numbers for this month, I want to say, as I do each month, that the stats I present here are drawn from the North Star Multiple Listing Service and cover the 7-county Twin Cities metropolitan area. All right, housekeeping out of the way. All right, I'd like to start with new home listings because they are the heartbeat of the market. And after a little bump in August, new home listings fell again in September. Metro-wide, there were 5,051 new listings in August and just 4,774 in September. Seasonally, we kind of expect to see that drop off. However, new listings were down 4.7% compared to last year, and that's kind of been an ongoing trend this year. And if we look back to 2021, the number of new listings in September that year were quite a bit higher, 6,100 at plus, to be less than exact. That's a 25% drop in just 2 years. Ouch! Even though the number of new listings fell in September, the total number of homes for sale last month did eke up just a little bit, from about 6,700 to about 7,100. Compared to September 2022, though, the total number of homes for sale in September fell by about 8.2%. So what we have is fewer homes coming to market and fewer homes on the market than we did last year at this time. But even with that low supply of homes for sale, homes are now staying on the market longer. They're taking longer to sell. And that's where we can see the impact of those interest rates. In real estate, we look at a measure called month supply. And that's the time it takes to sell all the homes that are currently on the market if no new homes were to come to market at all. So the supply of homes for sale in September was at 2.3 months. And we haven't seen a number like that since September of 2019. And at that point, there were quite a few thousand more homes for sale. But don't get me wrong, this is still considered a strong seller's market. The low inventory of homes for sale is keeping the buyers that are out there pretty active. And as I've mentioned before, typically what we consider a balanced housing market is a market with an equal number of buyers and sellers. And that market has about a 4 to 6 month supply of homes for sale, and we're at 2.3, so still a seller's market. Another measure of market activity is median days on market, or the number of days it takes when you list a home to when it goes pending. In August, the median number of days on market was 14, and that edged up a little bit in September to 16. But I just want to put this in perspective for you folks. At the peak of the Great Recession in 2008, the number of days on market was 144. So the sky is not falling. 16 is really not a lot. It's just more than it has been the last couple of years. Now let's talk home prices. The median sale price in September dropped to $375,000. Now that's about $10,000 lower than it was in August, but that's still 2.5% higher than it was in September of last year. So home prices are overall still trending upward. And sellers are still getting 100% of their asking price on average. We aren't seeing a lot of discounting going on, and we're not seeing those crazy bidding wars that we were seeing for a while, and good riddance to those. Moving on to interest rates. Interest rates started the week at a 23-year high of 7.8% for a 30-year fixed mortgage. Now, I know that sounds like a lot, and it is definitely higher than mortgage rates have been for, 23 years. But I bought a house 23 years ago, and I paid 8%. And I've lived in that house ever since, and I bought down my mortgage over time, so now my mortgage is at, I think it's at 3.75%. So interest rates are temporary. Home prices and the payment that you're making, those are the things that you should be looking at if you're thinking of buying a home right now. Interest rates, you can refinance, you can get a lower interest rate. Okay, soapbox over. So what are the takeaways from this month's report? Home prices are mostly holding steady and even increasing slightly overall, despite the uncertainty in the larger economy, including wars, congressional meltdowns, and inflation. So the supply of homes for sale remains low, but interest rates are keeping many buyers sidelined. So if you can't afford to buy now, competition for the homes that are out there is much less than it was during those crazy pandemic years. And many homes are selling at or near the asking price, and some above and some below. Just remember, every situation is different. If you want to know how these market trends affect your plans to buy or sell a home, or if you want a more specific market trend analysis in a particular city or neighborhood, you can call, text, or email me. I'm here to help. Thank you for watching, and I'll see you next month.